Hello and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Taher Badshah, CIO at Invesco Mutual Fund. Welcome, Taher.
Thank you, Ruchira.
Now, you've been in the world of equities for over 30 years now. So, what got you interested in stock market and what made you stick with it all these years?
So I actually graduated as an engineer, and therefore, equity markets and stock markets were probably not something which fell anybody near me. But I think I got interested along the way, and especially during my management days. Uh, I generally prefer to do something which is analytical, and to that extent, I think that is what was the starting point. And uh, obviously, at that point in time, opportunities as an engineer were relatively more limited compared to what they are probably today. And therefore, it was probably important for me to find something which is more parallel to what skill sets I generically brought to the table, and that was about analytics. And obviously found it relatively more lucrative along the way as I discovered more and more about capital markets, learned more and more about capital markets. I think by the end of my stint as an MBA student, I was pretty sure and clear that the one thing which I want to do is be associated with the equity markets, because that is where I could probably bring both my skill sets as an analyst as well as an engineer to the table, and alongside which, of course, it was financially more lucrative as well. I will not deny that. So I think that is what propelled me in that direction. And once I was set, I think it was by and large very clear that this is what I will probably pursue as a career. I didn't really want career which was more sober and straightforward 9 to 5 kind of activity. This was something which I discovered is more 24 by 7, and something to that extent which is relatively more energizing so to speak. So I think that's how I settled down as an analyst and then as a fund manager along.
Right, great. Now, with all the market ups and downs that you've experienced, what are some of the biggest lessons that you've learned about handling market cycles? If you could share some of them.
It's evolved at different stages of the career. Like when I've started off as a very budding fund manager, it was more about actually seeing and observing and trying to understand from some people who were stalwarts in that activity, and that was one phase. So it was a learning phase, and at that point in time, it was important to be completely unbiased and open-ended about how to approach the market and so on. I think in the second phase is when you actually start to kind of become an expert at the game that you are trying to play, and in that it is important that you have those analytical skills yourself, which you can bring to the table at that point in time. So in the first phase, you are more like an observer. In the second phase, I think I started to look at it more as an analyst. I think this evolution continued, and as you get into a more mature stage where you've mastered what you've actually trying to do, you then start to try and reconfigure this as per your strengths and weaknesses. That is when you start to actually put your construct, your mindset into the game. I think every individual from an investor standpoint is different and has his own mental configuration. It is important for one to assert that in your fund management approach. So I have over a period of time I've learned to believe that, look, you take inputs from everybody, you learn from everybody, you take advice from everybody, but ultimately when it comes to fund management, it is important that you do your own bit. Markets obviously subject you to different kinds of cycles. It is obviously important that you've spent sufficient time to have come across various kinds of market cycles. And in my 30-year journey, therefore, I've been fortunate that I've been exposed to various kinds of market cycles, from the dot-com boom and bust to what we saw during somewhere between 2009 and 2012 due to the global financial crisis, and then more recently, even in the last 2 3 years, the pandemic related challenges. So this has thrown up different kinds of experiences and different kinds of learnings at different at during these periods. And we've seen shorter cycles as well. We've seen banking-related stress in India. We've seen the IL&FS crisis. Um, and not just the crises, you have learnings out of some of those very strong periods of market performance as well, like as we've been witnessing since the pandemic over the last 2 3 years. So I think it is important to have spent adequate amount of time for you to be able to distill and to be able to correlate, uh, what can probably go wrong and what probably can turn. So there have been several learnings along the way, I would like to think. But the most important thing is to kind of, I would really like to assert. One is that keep it as open-minded as possible. There is no one particular template which always works in the market. You have to be adaptive. Your skill sets have to kind of change over a period of time, and learnings have to be incorporated. And the second thing is, I would like to say, is that you have to be on the ball. Speed is of essence as far as the market is concerned, and especially when you're managing public money. It's important to be early in the game to identify trends reasonably early on, and from that standpoint, obviously, try and take a holistic view of things.
Taher, coming to the equity markets, we have seen relentless rally in the Indian equity markets. And recently, we have seen some of the concerns due to the global geopolitical tension. Do you think this rally can continue? Or in terms of management, do you think it is to play safe? Or are you finding good opportunities in the current market scenario?
So, Chirag, I would like to say that, the way we think of the market configuration overall situation today is that we don't have a choice as investors but to uh, separate the economic cycle from that of the market cycle and evaluate them separately. When we look at therefore the economic cycle, we find that we are in a reasonably good situation. I'm talking about India's own domestic economic cycle, and obviously some of the global implications which come along with it. But by and large, from an economic standpoint, we are in a fairly decent place. We don't expect deep corrections to therefore unfold. Can we see cyclical corrections in line with the um, uh, loss or gain in earnings momentum? I think that's what we'll have to probably contend with in the coming times. See, I think at one level we are, when we look at the market today, we are obviously not at the early stages of the market cycle. We are somewhat at the more mature stage of the market cycle. And obviously valuations are not of the type which are very easy to navigate. Having said that, I think to your question about opportunities, I think opportunities are still there in the market. We don't really feel very constrained about the fact that we're not able to invest money or incremental flows cannot be deployed or things are uh, across the board so expensive that they are just not touchable. I don't think we are in that mode, but obviously there are some of the things that we like have moved well, and that obviously has contributed to our performances. But is everything as expensive? I don't really think so. Even in the mid and small cap space, we feel some of the businesses in certain areas, whether it be technology oriented companies or even probably few companies in the healthcare and pharmaceutical space, alongside which even sometimes in the segment of commodities. They do provide opportunities once in a while. And uh, Last but not the least, I think we continue to see a good flow of new businesses which come through the IPO route. Obviously, they don't start off being cheap to begin with, but many of the IPOs do undergo time corrections. If you're lucky to probably participate at the very outset, that's fine. But if we don't, I think they do go through periods of consolidation. But important thing is that quite a number of these businesses do tend to be attractive. They are many a times new generation businesses. They come with their own set of competitive advantages, which perhaps we've not seen earlier. So not to say that everything is investable here and everything should be pursued, but it does provide that extra set of opportunities which we can probably look to. So I think net, I would say, Chirag, it is still a market which is investable market. It has its pockets of uh, uh, you know uh, overvaluations and to some extent some companies very exuberant as well. We have to distill that and we have to make sure that we avoid some of those very obvious pitfalls in the market, so to speak, and not get carried away. I think just keeping that right portfolio balance should see one through at this stage of the market cycle.
You have been in the markets for around close to 3 decades. Could you just help us? What is your style of investment? How do you manage the funds? And what kind of markets really excites you?
Well, I think there are challenges with both types of market, good as well as bad markets. Bad markets, in any case, are challenging because investors don't see much of return. It is very enjoyable from the point of view of fund managers because you get to buy things which come quite cheap, and except that it involves a waiting period. Good markets at the same time are also challenging, as we are undergoing and witnessing right now, which to some extent over a period of time does constrict your opportunity set. And obviously, you have to deal with market exuberance and valuations, which may not necessarily be the most appetizing, at least from a shorter term standpoint. You then need to make your investment horizons relatively longer, and keep your return expectations um, uh, more in check compared to otherwise. So I think each has its own set of uniqueness and challenges, but obviously, we have to find, as professional managers, we have to find our way through both these types of market conditions, perform nonetheless, and and position ourselves accordingly. I started off as a growth investor, and I generally have thought about markets from a growth standpoint all throughout, and particularly during my past stints prior to Invesco. But Invesco actually, at some level, also helped turn some of these things for me, made me relatively more broad-based. At Invesco, we run a strategy which is a value strategy, known by the Invesco India Contra Fund. This fund has been a flagship strategy throughout the last 7-8 years, I would like to think, and even today happens to be the largest fund in our system. Contributing nearly about 25% of our total AUM at this stage. India is typically known to be a growth market, and probably will remain a growth market for the foreseeable future. And therefore, to think of value ideas in the Indian context is not easy. It's not like what you see in developed markets, where many sectors and many industries have matured on their growth path and therefore have turned into value at some level or the other. I think therefore we have to approach value differently in the Indian context. It's a combination of value and turnaround, but still quite different from what you encounter otherwise as generally accepted value strategies. What we do at Invesco is we run every strategy by their respective mandates. The two pillars of our investment process are that we want to make sure that we are active managers at all points in time, and the other pillar being that we want to run all our strategies true to their respective mandate. So if it is a growth strategy, we obviously have to use growth as a mechanism, and value, if it is a value mandate or a contra mandate, then we have to approach things from a value stroke contra standpoint. So I've been well assisted in this endeavor by the process which is available to me. But along the way, personally, for me, it is it's not easy, but it's given me that opportunity to wear different hats at different times. I do manage a few of the growth strategies as well, whether it is a small cap fund or the flexi cap fund, which requires a growth orientation, even the focused strategy, which requires a predominantly growth orientation. And when it comes to running the Invesco India Contra Fund, that is about just switching the hat and trying. So I think it's nice to have developed those capabilities. It's not easy to kind of change those hats very easily, but I think I've been assisted, like as I said, by the investment process which is available at us, which has probably made this a lot more doable and easy.
We'd also like to know a lot more about the red flags or the signs that trigger your decision to exit a stock.
One thing which usually is a very easy trap is focusing only on the P&L statements and not focusing as much on the balance sheets of companies. Many of us, as even seasoned fund managers, do tend to get influenced or drawn into very strong, attractive P&Ls, both of the past and possibly of the future of many of the companies. But it's important that the growth objectives of some of the of companies that we want to look at from an investment standpoint are achieved through stable balance sheets as well. It is important that we don't get carried away just by the P&Ls, because sometimes the growth comes at the cost of the balance sheet. Balance sheet related issues can drag on uh, for uh, for a much longer period of time. P&Ls, if we were to go wrong on our P&L calls, I think that is still manageable. We will encounter cyclicality of earnings, but when we encounter, or we get into situations where the balance sheet turns into a stress proposition, I think that's a lot more difficult to come out of and a lot more difficult to handle. So as far as possible, we try to ensure that we don't look at weak balance sheets from a starting point. So this is clearly one pitfall that we all encounter. I think the other is about obviously the quality of managements, and there is no single formula around it. Uh, I think having managements or businesses which have delivered some reasonable amount of consistency of growth and performance of the business in the past is a good starting point. You may not necessarily have that at all points in time, and in such instances where you don't have that consistency, then I think you need to be a lot more. You need to have a better handle in terms of the people that are managing the business. You need to understand the styles and evaluate them from a different standpoint. I think these are more softer elements of investing, and we have to take them as case by case as they come. But very new businesses which are completely unproven and probably do not have a good starting point from the point of view of the balance sheet is something that we would ideally want to avoid. Uh, and last but not the least is once again common pitfalls about changing business conditions and the competitive landscape. I think that is the other challenging part. Again, which goes to detract the uh, long-term viability of the businesses or the terminal value of the businesses as I talked about. We encounter those kind of situations now a lot more compared to in the past, given technological evolution, given new businesses which come in as competition, given new ways of delivering goods and services which are emerging, do put quite a lot of the traditional businesses at risk at various points in time. I think it is very important to evaluate that well enough, and ensure that you don't end up with accidents.
Sir, now coming to the Contra Fund, Invesco Contra Fund, you spoke about it earlier, but just wanted to understand if we look at the performance of the last 3 years, this fund has outperformed the benchmark index BSE 500. But if we compare it to peers, it has not done that great. However, in the recent past, it has, the gap has been narrowing. So, what has worked for the fund in the last few months, or we can say few days, weeks?
So great question, Chirag. This is exactly what our process is all about. So I think more particularly from the point of view of the contra fund, look, we need to realize that, um, uh, uh, you know, like as I said, this is a value mandate. This is a value stroke contra mandate, and uh, uh, growth at one level, growth oriented strategies have a have a somewhat more standard definition about things. I mean, we are three of us on this call, and I think if we talk about growth, we all probably will be on the same page as far as what growth means to all of us and what would we like to see in a company where we are talking about growth as the driver. But when it comes to value, I think all of us are, or at least one of the three of us can probably have a different opinion about what value means. Value at some stage is in the eyes of the beholder, and to that extent. Uh, there could be companies which are trading at 50x and probably growing at about 50 odd percent. And even that can probably imply value to some people or some investors in the street. And it could mean something completely different for another value manager. So I think value does have different connotations, and that leads to uh, the differentials that we see in performance, and especially during certain parts of the market cycle between one manager and another, because somebody would have a different perception about what is value versus somebody else. It's not as straightforward and uniform as a growth definition as such. And I think that is probably what uh, uh, explains the our relative performance to peers, perhaps 2 years back and probably now. We will all go through our own cycles in that process, because the market might have its own overriding cycle in which different parts of the value market and different parts of the growth market might be perceived differently, and it would depend upon how your portfolio is configured. But having said that, I think at our end, we have, while managing the Contra Fund, we've been basically seized of two things. One is that we've always told investors that our value strategy is about buying headwinded businesses, wherein we are not seeing good trends as of now, but where we believe on hope that, as I said, it's important to have long-term visibility of businesses. And if we think that they might be headwinded, but there is a potential for some of those headwinds to clear going forward. And if we have reasons to believe that that company still retains the necessary competitive advantages for it to emerge out of those headwinds, then I think that becomes a good starting point for the Contra Fund. So we buy into headwinded businesses, believing that things will turn. And as the company once again starts to reassert itself into growth and gets into a growth mode, that is how we crystallize our value. Because what we will see is in that process, not only earnings expanding, but even valuations mean reverting. And that is how we would get our gains and make our money. However, in the Contra Fund, once again, we caution investors that it is important to take a somewhat more longer term view of things here, because, as I said, unlike in growth companies where we are already seeing continuity of growth, here we are talking about buying businesses which are not doing well right now, but probably likely to do well later. And this transition from headwinds to tailwinds is not an easy process. It doesn't happen very soon. On most occasions, it does not happen soon, and a few times it might happen very fast. So we have to be patient, and therefore we always insist on a somewhat more longer investment horizon in the Contra Fund versus other strategies, or at least the other growth-oriented strategies. We insist that investors should at least have a minimum, typically 3-year investment horizon for such strategies. Whereas in a growth strategy, you might even come in for a shorter length of time, because this 3-year block is, to our experience, required for businesses to achieve that turnaround or for headwinds to convert into tailwinds. And therefore, when you see the performance of the Contra Fund on a 3-year rolling basis, you would see that we always 95% of the time, or maybe even more, outperform the underlying index on a 3-year scale and more than a 3-year scale. So on a 3-year, 4-year, 5-year note, we don't really have a challenge in terms of our performances in the Contra Fund. But do not look at Invesco India Contra Fund from a shorter term standpoint of less than 3 years. And as you rightly said, even during that time in the last 2 years when we are probably not doing as well relative to peers, we were always outperforming the benchmark even during that period of time. So for us, it is important. What we keep an eye on is, are we able to beat the benchmark consistently over reasonably long-term periods of time, 3 years, 4 years, 5 years and above. If we've done that well, then peer group rankings essentially is something which is more like an outcome, and like as I said, is a function of how different peers think about value and the definition of value at their level individually. And as that changes with market cycles, that will probably have situations where we might be found at the bottom of the table, or below average at certain points in time, and we might be well above average, like as we are today, versus our peer groups at some other points in time. So that's something which we don't necessarily stress too much about. What we are focused on is that, are we delivering that necessary compounding, as well as that feature of outperforming the benchmark at least on a 3-year plus scale.
Right now. So we noticed that you hold several high PE stocks in your portfolios. There are stocks that often come with higher risk. So how do you balance risk and reward when holding high PE companies?
So, Ruchira, here, as I said, some of these high P multiple companies are also their valuations are higher, not only for the primary reason for them to be somewhat expensive is that they provide that necessary longevity of growth and the pathway in terms of their ability to kind of grow this business for a much longer duration. And the second being that they are reasonably high quality in from the point of view of being a good quality, a good clean balance sheets, not levered. In most of the companies that we own, we don't really have any leverage of any meaningful magnitude. In fact, many of them are high cash flow generating companies and high cash companies. So to that extent, I think valuations then become a lot more supportive. We don't necessarily need to think of uh, uh, you know uh, a significant valuation compression here. Yes, it is possible that we might go through some valuation compression, but not of the order where where we are where we le- where, which leads to fatal accidents. So I think that is what how we at one level we think about this, that they are good quality business and that therefore they will merit on an average somewhat higher multiples, or they'll command higher multiples compared to the rest of the street. I think the way but yet we are cognizant of the fact that some of these at certain points in time can um, have periods of underperformance, especially after they've risen for a very long time and valuations have gone beyond a particular level. There could be situations rather where the stock has done very well, valuations are expensive, and we find that either growth is faltering or some other developments have taken place which perhaps need to make us even more cautious. Then I think we don't hesitate to exit that stock entirely from the portfolio as well, because obviously we can't beyond a point extend the length of the portfolio. So I think this is how we manage risk. And like as I said, the best way to otherwise manage risk on a continuing basis is to make sure that the portfolio is reasonably diversified. So even today, despite the fact that we just run 20 stocks in the portfolio, we have exposure to almost every possible parts of the market or themes of the market, whether it be healthcare or whether it be manufacturing or whether it be energy or whether it be defense, and banking and financials and so on and so forth. Uh, we also at times, at certain points in time, for example, maybe this is the time of the market where we believe that it's not a bad idea to have some value composition of the portfolio as well. So while still it is predominantly a growth strategy, we are operating at perhaps both ends of the barbell. We have a good amount of growth, but we balance it by having some value stocks which are not as expensive, which probably have not seen as much movement in the market at this in the last some time and have underperformed or so on. But businesses are still of a decent quality. And this blend essentially makes sure that even though there might be some high P multiple stocks, but at an aggregate basis, the portfolio is still quite comfortable relative to the growth that it provides.
There has been talk about the new age tech companies in the past few years in the market, and you hold few of them which has done phenomenally well in the last 2 3 years kind of thing. What's your overall view on the new age technology companies given their mixed response in the last few months or years?
So the operating metrics are not very different. I mean, we apply the same yardsticks essentially to some of these new gen companies, to even some of the IPOs which come. We apply the same. We don't do anything different in terms of our process and identification. So uh, 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 more particularly for the new gen companies that you mentioned, that you're referring to, the two or three things that at least I have kind of uh, used as guiding principles in my head is that one is that the it should have a reasonably decent competitive advantage, because some of these new gen businesses are very easy to replicate, duplicate, and entry barriers typically tend to be low. So if that company operating in that segment has created a decent gap uh, with the number two player or the number three player in that same business, then we have a longer runway of growth because it's a company which probably has a leadership factor and which cannot probably be as easily bridged by some of the other upcoming players in that particular business. So we try to see that, is there that longer edge of competitive advantage which those businesses enjoy. The second thing is that I think in this some of these new gen businesses, obviously profitability as a starting point is always low or perhaps not existent, and they are in a strong investment mode at times. So basically, we don't mind that investment because we know that these businesses do require that capital, especially if it is not leading to any creation of any meaningful leverage on the balance sheet. But it is important to also ensure that profitability is not too distant. We don't want to be in businesses which are new gen, but where profitability will come only 5 years, 7 years, 10 years from now. We don't want to take that kind of a long handle because we may not necessarily have the tools and visibility, tools and wherewithal to be able to measure the visibility from that standpoint. So I think it is important that some of these companies do have a somewhat shorter runway to achieving profitability. That at least becomes a good second factor to take into consideration. And the third, of course, is the softer aspects of the management and the team which is running the businesses. So I think we have kept to that principle, at least in my head, and that is why a couple of businesses which we managed to buy have not done too badly for us. And at the same time, we've been able to avoid some of these new gen businesses, which even today probably have not done as well. Uh, but in all this, my overriding this thing would be that a view would be that there will be some of these new gen businesses which will scale up, which will become meaningful, which will achieve leadership position and profitability as well. And we've seen that happen in a few of these, even though there was original skepticism in the market. But I think eventually they've delivered. It's not a good idea to kind of dismiss all of these as froth or as something which is just they're just a bull market uh, you know bull market instances. I think it is still important to carefully evaluate some of these because they define new paradigms, new ways of satisfying the consumer, delivering experiences or products to the consumer, and therefore need to be evaluated as such. But there will be a few of them which will matter, and it's important that we try and be a part of this.
Tahir, from a long-term view, if you look at a 10-year period, a decade period, which are the sectors which you think can outperform the markets, and which are the sectors where investors should stay away?
It's a difficult question. I think there will be like as I said, the world is changing pretty rapidly. The lifestyles are changing rapidly, and we all know what we are all going through, and our own lifestyles today versus what they were 5 years earlier, pre-pandemic, post-pandemic, are quite different, and that will call for new businesses to come along the way, and some of the old businesses facing some challenges along the way, and then there will also be some traditional businesses which will probably continue to exist the same way as they've probably been before, but obviously we have to be a lot more alert to changing technologies, changing ways of doing business, etc. So hard to take a 10-year call, and I think at least from a investment standpoint, we do not want to get fixated. Like as I said, the style is not to is to be quite as open-minded as possible. Open-minded with a view. You don't have to be open-minded and then not have a view at all. I mean, you embrace as many of those newer things and opportunities and the way the market is behaving, and try to examine as many possibilities all around, but ultimately cultivate a view of your own. And I think at this stage it is in it's it may not necessarily be right to think everything from a 10-year standpoint, and yes, you try to visualize as much as you can, but you will have to provide for uncertainties along the way, and course correct if need be, because you may not have answers to all the questions as they evolve. So my short point being that there will be some businesses which will continue to perhaps exist the way they are. Let's say banks, for example, some technology companies. You would probably see even some of the consumption related aspects. Consumption will be an interesting basket because it will be a combination of old and new. So there'll be some products which will continue in the old format, and some which will be served in a new manner, either as a product or as a way of delivery. So I think that will behave as such. Maybe sectors like commodities, etc., will have their own cyclical tendencies. There you have to essentially think of them as from a cyclical standpoint and identify them at the right time of the investment, right time of their cycle. That is predominant. That is important, and that is the most relevant thing as far as managing or investing in commodity companies is concerned, or commodity sectors are concerned. So I think this is how we'll have to, think of them. There are some long duration sectors. There will be some sectors which will be uh, good, reasonably decent, medium to long term stories, but perhaps with the risks. And then there'll be one section of the market which will always have commodity or cyclical kind of features, and we have to treat them, give them that cyclical treatment, buy them at probably the lowest point of their cycle or the beaten down times of the cycle, and probably be cautious when they are at the top end of their or the more mature end of their product cycle.
Right now, with valuations at record highs, is it getting harder for you to find good investment ideas? How do you still find value in a market like this?
I would like to admit that we are now in terms of absolute cheapness, it is not easy. We have absolute cheapness in very few instances, but much of the time we are more about the market is still about relative cheapness or relative valuations, or probably businesses which are trading at the lower end of their own historic valuation bands. Um, uh, and uh, uh, and we have to take it from that standpoint. I think uh, uh, there once in a while you do come across companies which are GARP, where the growth is reasonable, but valuations are not as cheap, but at least justified by the possibility of by the growth that they probably bring to the table, at least over the near term, over the next 2 or 3 years time. So you do find companies which probably, let's say, can grow at 30% and maybe at, let's say, 30x. Uh, uh, and if you're convinced about that, then that still might merit and make sense. And uh, uh, but otherwise, I think it is not that we find very companies which are absolute cheap, except, let's say, in sectors like commodities or oil and gas and a few of those types, or maybe even in case of banks, for example. Banking in general is still quite okay. It is reasonable. They're cheap, and they're perhaps even cheap compared to their own historic historic bands. So I think it's that's how we actually manage the valuation hurdle. Uh, and as I said, then the other way to make sure is that individual stocks may be expensive or individual stocks may be cheap, but how do you blend them in the portfolio, and how do you give the right weights so as to make sure that at a portfolio aggregate level you don't really have a very expensive portfolio, or a very, I mean, you have the right blend and you have the right balance in terms of the growth as well as the aggregate blended valuation of the portfolio. So that's how we treat the valuation challenge today. And the last way probably to deal with this scenario is that, yes, you might probably buy into some of these companies which are expensive, but then you have to, A, like as I said, you have to moderate your return expectations, and B, you have to make sure that they have yeah, the possibility of derating is as low as possible. They should be businesses which provide you the longer handle, and because if that is the case, then even if you were to probably buy somewhat expensive companies in the short to near term, I think you will still work. It will still work out reasonably well, especially if you can extend your time horizon and the business continues to grow and has that long pathway of growth.
Taher, now coming specifically to the banking sector, do you think banks are currently undervalued, and what will drive their growth in the coming decade or so?
I think yes, there is an apparent valuation cheapness which is there. I mean, they're fair to somewhat cheap in my opinion, especially given where we are in terms of the entire banking space itself. It's evolved quite a lot over the last some years. It is now one of the more you know more from a balance sheet perspective, as we know that the banking sector in India has seen a lot of improvement in the last some time. So to that extent, it is and then at the same time, if you see valuations are being on the cheaper side, it makes you a lot more confident. We can understand cheapness when we are confronted with the challenge of balance sheets not being as strong, but we don't really have that risk right now. Maybe in a few pockets, yes, but by and large, the sector is reasonably fine. I think it is we've gone through a little bit of the rate cycle as well, which is probably affected the valuations of the banks. I think maybe we look forward to the unfolding lower interest rate regime coming through now over the next 12 to 18 months, and most likely will probably be maybe somewhat negative in the short run for banks from the perspective of the margins. But I think through the cycle, I think they will probably have a better a margin profile, given that perhaps cost of funds, which has been a challenge, will probably recede and lead to a cyclical recovery in their profitability. So at this stage, at least, I'm inclined to think about banks more from a cyclical standpoint, if not a structural standpoint. What we are looking forward to is steady compounding in book value. If it can get to somewhere between 13 and 15% of book value compounding, and if that were to happen, then they are not too expensive from that standpoint, and especially given that downside appears limited, given that balance sheets are in a relatively better shape compared to for most banks, both on the private as well as on the public side. So when we think of it from a risk reward standpoint, it appears a lot more balanced, perhaps even on the positive side, compared to perhaps a few other pockets of the market. And that's where a patient investor can probably look forward to at least a minimum compounding of a certain decent order. And if everything goes well, then there's a possibility of valuation expansion also coming through.
Okay. Yep. And Taher, lastly, before we wrap up this chat, thing on the small finance bank, which has been growing quickly but has more risk. Do you think they are good investments, and what do you look at when evaluating the small finance bank?
Again, whether be the large or the small finance banks, I mean, idea is to when we are obviously in the case of the small finance bank, uh, uh, we are confronted with a somewhat different kind of customer set, and to that extent, asset quality matters perhaps a lot more than or what it is for the others, or the mid-size or the large frontline banks. This is also a space which has its own nuances and a few factors which are specific to them, whether it is state level volatility or whether it is certain specific conditions, microeconomic conditions, if not macroeconomic conditions, which influence their asset qualities, their growth, and their profitabilities. So I think it requires a little more diligence. It is not an easy space to be in. Besides, it is also somewhat more competitive, especially in the microfinance space. I think small finance is operating in, let's say, the mid and the small MSME segment is relatively more doable compared to the microfinance space, which is a lot more challenging in many more ways. But in all of these, it's the trinity of basically the growth, the profitability, and the asset quality, which all need to move in the right direction. And that is what will probably determine their that is what will determine what kind of returns you can probably expect out of some of these opportunities.
All right, with that, it's time for us to wrap up this chat. Thank you, Taher, for taking the time to speak with us and answering all our queries so patiently.
Thank you very much for having me in. It was a pleasure speaking to you guys. Bye.
Thanks.